welcome. Dr. Donna Vargas here. Before we get started on today's topic, I want to bring you back to the very first lecture session that we did a few weeks ago, where we discussed a broad definition of what is accounting. Does anybody remember what we said accounting was? It's the language of business, and we say just about everyone does some form of accounting. Under that definition, though, we have what? Two main types of accounting, right? The first one is managerial accounting, and the second one, financial accounting. We said managerial accounting are financial transactions that are for internal users, right? That are used by internally within the organization, while financial accounting are financial activities and transactions that are used for external users. So your shareholders and your stakeholders are examples of that. Today's topic, we want to focus on the financial accounting portion of it. Now, since financial accounting is used and is geared towards external users, these individuals usually need information that are standardized and formatted so they can make, whether it's predictive analysis in regards to what's going on in the organization, they can analyze the data for to see if there's any theft. They can also see if you're making a profit. They can use these information in so many different ways to make informed, detailed decision because they're external users and they're not inside, right? So under financial accounting, though, for how would they get these information? And there are four main statements, financial statements that are out there, and that's what we're going to discuss today. Now, once you hear the word financial statement, that also tells you that it is not managerial, it's under the financial side, right? So we have what is accounting. Underneath it, we have two main types. We have our managerial over here, and we have our financial. To get information for external users, there are four main types of financial statements that are out there. So let's get our pen and paper and let's do a deep dive in what are these statements, who uses them, when do they use them, and how people use them, when, where, how, all the deep dive of it. All right. So the first financial statement that is out there is the income statement. So the income statement is the first one. The second one is the balance sheet, right? The third one is the statement of cash flow. And the fourth and final one is the retained earnings statement. So you have your income statement, you have your balance sheet, you have your statement of cash flow, and you have your statement of retained earning. So, all right, did we get that? Income statement, balance sheet, statement of cash flow, and retained earnings statement. Okay, so let's discuss all four. So what is the income statement? So the income statement is also known as the profit and loss statement, and that should make a little bit, some bells go off in your head, and I'll tell you why. So it shows the revenues and expenditures during the reporting period, right? And so it will show if the organization or the company is making a profit or a loss. It is actually just a fancy budget. Don't tell anybody. Remember, I told you at the heart of all financial statements lie budgeting. These massive, major organizations, they call the income statement, balance sheet, the income statement, profit or loss. It's truly just looking at your revenue and your expenditure and see if they're making a profit or a loss. What do you do even though you're not an organization? Remember that budget that I told you to do? That's exactly what you're doing, but they call it a fancy word, and it's called your income statement. So, all jokes aside, so the income statement, as we mentioned, is also known as the profit and loss statement, and it helps to determine your expenditures, the organization's expenditure, and based on that, they determine whether they have to do cutbacks where it's necessary. It helps you to make financial decisions all of these supposed to sound very familiar, especially for those people who decided to do your budgeting as I recommended. So your income statement is also it shows you the operational results, because they it has your revenue on it, your income, your cost of goods sold, your gross profit, your taxes, your depreciation, your EBIT, which is earnings before income taxes. So it has all of these key performance indicators on it, but the main thing is to look if you're turning a profit or a loss. So the income statement is actually one of the most important financial statements that are out there. If I'm going to invest in a company, or if you're going to invest in a company, you want to look at their income statement for that specific period so you can tell what is going on from an operational point of view. All right. The second one is the balance sheet. I actually love the balance sheet because the balance sheet gives you a snapshot of the overall health of the organization. And I tell someone that think about it almost as your phone. You know, you would take up your phone and you'll take a picture. The balance sheet is a statement. It never ends. It keeps on going. But what it is, it just gives you a snapshot in a specific period of time, and it shows you what is going on from a asset, a liability, and an owner's equity. So what I mean about that, because the balance sheet, you can pick up the balance sheet and you'll get a lot of ratios on it. So it will tell you your assets. It is comprised of your assets. What are assets? Assets are things that you own. It can be tangible or intangible. It has liabilities on the balance sheet. What are liabilities? Things you owe. And you have equity. What are equity? After you use what you own to pay what you owe, what you are basically left over with in regards to your overall worth. So your balance sheet, the three main compartments of it is assets, and you have a list of assets, different types of asset, but it's things that you own, be it tangible or intangible. Your liabilities, things that you owe to others, and you have your overall equity of it. The balance sheet, why I like it, is because of the balance sheet, and through the balance sheet, you actually have the accounting equation. So the major accounting equation that is out there, where its asset is equal to liability plus owner's equity. So you're like, how can I remember it? So the balance sheet can be a T form. You have assets over here, you have liabilities here, and you have owner's equity. So asset, the equation is asset is equal to liabilities plus owner's equity. And then, you know, you can also do it different ways, as in your liabilities is equal to your assets minus your equity, or you can do all these different configuration of that equation. But the main equation is asset is equal to liability plus owner's equity. And that's where you get it from, the balance sheet. The third one is the statement of cash flow. And as it sounds, the statement of cash flow shows the inflow and outflow of cash activities during a specific period. And I want to put a little asterisk on the cash flow, the statement of cash flow, because it's usually being used by smaller businesses, because you do want to keep track of what's going on in regards to cash, because cash is king and it can walk out the door without anyone tracking it. And it's it is the hardest type of currency to track. If I drop a $20 on the floor, the next person that has it in his hand, that's the owner. If I drop, God forbid, one of my checks on the floor, it's harder for someone to cash that check because they are not me. So the statement of cash flow allows you to track the inflows and outflows of your cash activity during a specific period of time. And then you can use that to tell you basically how liquid the company is, and you can compare it this year over last year. And the cash flow is sometimes also compared to the income statement. And the reason why is your net profit or loss is sometimes out of sync with your actual cash activities, because not every business uses all types of cash, uses cash per se. So they might get paid via banking or check. So sometimes the income statement and the cash flow statement is out of sync. And so the cash flow statement basically merges the balance sheet and the income statement together. Does that make sense? Because cash is an asset, but not all the activities that are on the statement of cash flow will necessarily be on the balance sheet or on the income statement because of the accrual basis of accounting, meaning when I get the money versus when I do the work. So one of the takeaways with the cash flow statement that you should remember is that it merges the balance sheet and the income statement together. It helps to merge them. It's like the common thread. And the fourth and final statement of a financial statement is the retained earnings. The statement of retained earnings are used to show the change in equity during a specific period of time. And that retained earnings can be used to invest, or it can be used to pay off a liability. The statement of retained earning is the least important, or maybe important is the wrong word, is the least requested of the four financial statements. So in order of priority, most people, if I want to look at what is going on in your company, the first one I would like to look at would be your income statement, because your income statement, as is also known as your profit and loss statement, it shows the operational activities that are going on, and it shows me your revenue versus your expenditures. It shows me what is going in, what is coming in, what is going out, and whether you're making a profit or not. Then people like to look at the balance sheet, because the balance sheet gives you a quick snapshot of the health of the company. And from the balance sheet, you can get all these different ratios. When we get into ratios, whether liquidity ratios, solvency ratios, then you usually can get them from either mostly the balance sheet and or the income statement. And then the statement of cash flow, as we've mentioned again, mostly used for small businesses, but it records the actual cash that you have. And the statement of cash flow also shows your operational, your investment, and your financial activities. What I mean by operational activities, what product or services that you are offering to the public. Your investments would be whatever you're buying in regards to long-term assets, if you're using cash to buy it. And then from a finance, what debts or loans or even dividends that you're having on it. So in order of importance, it would be income statement, then balance sheet, really close together in regards to almost of a tie. Then you have the statement of cash flow, and to the very bottom you have the statement of retained earnings. So why people use them? If I'm going to invest in a company, I'm not going in blindly. I need to know all the information that I need so I can make an informed, detailed decision before I pick up my money to invest in the company. The SEC also uses that, because these four financial statements can tell them if something strange is going on, and through these four, they can even ask for additional information on it. So the external users that uses them, as we've mentioned, potential and current shareholders and stakeholders, people that want to do analysis in regards to what is going on with the company. I want to predict how healthy the company is going to be, how healthy the company truly is. I can compare and contrast to last year, double LY, even triple LY, going back 3 years to see what was going on and from that give a predictive measurement in regards to how they will look in the years to come. So what we will be doing, I will ask you guys to please make sure you also do your research, no different than what we've been doing so far. Please continue to do your independent research on this. And as always, the discussion will be tied towards the topic of financial statements. I do want to make mention, though, that we had some students who smartly, if they have any questions, for clarity's sake, not everyone sends me an email, but in the What I Have Learned This Week section, I have been having some students asking for clarity, and that is a great way where I can be able to see where there are any holes that we'll be able to make sure everything is clear. So if you have any question in regards to this, either send me an email, or in that What I Have Learned, you can also pose your question. Who knows, maybe one of your classmates will also answer this. So thank you very much, and as always, I will see you on the other side of Blackboard. Happy reading. Bye.